Well, firstly, thank you very much for everybody coming along today, and thank you very much to people watching us on YouTube or listening to us later on a podcast. We are filming and recording. We are at the Hermes Capital Breakfast Panel session, and it's called Breaking Ground, Debt Capital Challenges and Opportunities in Construction and Mining Services. We are very privileged to be joined by three experts, I've got to say, in the field of capital raising and contracts and all different aspects of mining services and construction. So we're talking about civil contracting, construction subbies, mining services. What these industries have in common is that they can be capital intensive. So obviously, certainly civil contracting and mining services. I was just in Karratha on Monday looking at a heavy haulage business and the size of these things. So talk about heavy equipment, it's about as heavy as it gets. And obviously in construction you get a bit of use. So it's capital intensive. And the other thing about these industries is that they're also subject to contracts. And we all hear about the subbies. When things get tight, they get screwed by contracts, and there's all sorts of traps. I guess some of the other interesting aspects is the enterprise value of these businesses is sometimes also very much determined on the quality of the contracts and how those contracts are written. I'm sure these guys will be able to speak to that as well. And all of these industries have, certainly the capital-intensive industries, have been affected by supply chain issues. I think we've seen a bit of a bullwhip effect.
Absolutely.
I don't know if anyone's familiar with the bullwhip effect, but it's basically, we saw that during COVID, no one could get hold of stuff, so everyone's hitting the order button. When you're hitting the elevator button and the doors aren't closing, and of course, then all of a sudden the stuff arrives and nobody needs it, and the price is dropping. I'm sure we'll hear all about that. So, without further ado, I would like to introduce all the panelists. My name's Nick Samios. I'm the fund manager and director at Hermes Capital. I guess these days we're called a private credit fund. We used to just call ourselves a finance business that's backed by an investment fund, but private credit's sexy these days. Personally, I've been in the game for over 30 years, more years than I care to talk about. Hermes has been going for 15 years. We're asset-based lenders in all around Australia, and particularly in the contracting space. We've kind of specialised in that. To my right, I have Hyman OAM, CEO of Hymans, Valuers and Auctioneers. Apart from anything else, he's a chartered accountant. You've still got that in your CV there. He's also the principal of Hymans, as I said, Hymans Auctions Valuers, sits across a number of industries. Been at it for a while. We'll introduce Ian a bit more in a moment. To my left, I've got Dr. Mark Rainbird, who's the chairman and founder of Blue Mountain Capital. Mark's got many years' experience in equity and debt capital raising, as well as corporate advisory. So advises firms not only on raising capital, but also strategically on their businesses, divestments, acquisitions, all of that good corporate advisory stuff. And Harry Mostert, who's an independent consultant. He's got extensive experience. He's been the CEO and senior executive of various businesses, including M Group. That's right. I haven't written that one down, but we'll give everyone the opportunity to introduce themselves shortly. As a matter of fact, I will start with you, Harry, and I'm going to ask you. I've got my questions written down here. I'm going to ask everybody on the panel just to tell us very briefly about yourselves and how you engage with these industries that we're talking about, civil contracting, construction, mining services, and just maybe if you can sort of put a place marker in what you think the biggest challenges facing these sectors are. And then let's see if we haven't covered those place markers by the end of the session. So, Harry, how about you start?
Thank you, Nicholas, and good morning, everybody. My name's Harry Mostert. A little background, I grew up in Papua New Guinea. My father had a civil construction business in PNG back in the 60s and 70s, so you can imagine back then it was really wild. Got to operate some pretty cool pieces of kit, D9 dozer when I was 12. We had a light plane. I could take off pretty well, but couldn't land very well. Dad never taught me how to do that very well. For the last 30 years, I've been across the construction, mining, infrastructure oil and gas in Australia and overseas. I work for some companies that are multinationals, locally and international, and private companies. Some of the roles I've had with these companies have been operations management, production management, manufacturing, sales management, and general management. So I've sort of been from the floor to the boardroom in some cases, having first-hand experience at how things work and how things don't work. I'm working with, for the last 2 years, I've decided to go out on my own, doing my own thing, and working in a business advisory capacity, helping, multinationals locally and internationally, taking product to market, commercialisation. We're working with a company at the moment, a Canadian company, bringing their brand into Australia, a big company called MBI Global, and they're a drilling OEM manufacturer in Canada. So there's a lot of strategy around bringing product into the market. So I'm excited to talk about this product line and the talk today.
Fantastic. Well, thank you very much. I guess we'll move to you, Mark.
Yeah, thank you. Mark Rainbird, Hermes Capital. I guess my background is in operations. Did a lot of work in mining, a lot of work with OEMs, Caterpillar, Komatsu, all those sort of guys. Used to work in private equity, so I've bought mining services businesses and run them. And we come across, a lot of people in the construction, mining services, civil, from the point of view they come to us for funding, or a transaction. So we've done some large transactions recently in terms of funding, those sort of companies, or doing M&A activity. So in terms of the issues that we see at the moment in terms of the market, or some of the headwinds these folk are facing, generally is around the changing market conditions. So, for example, a commodity cycle. People will be aware of the recent issues around nickel, for example, if you were exposed to that. Input pricing, so we're seeing steel and other input prices really jump, and so if you're supporting mining services or construction and you're in that space, that's a big issue. Labour shortages, just getting the right skills. You've got to pay labour a lot more at the moment. So talked about the price of materials, so that's the inflation part. And then, the other thing is part of all that is just understanding the cash flow cycle, especially when you're an asset-intensive industry. You've got a lot of your capital tied up in assets, and then the issue is you need working capital. So we see a lot of issues around just managing that and getting funding for either expansion or funding that working capital cycle, I guess.
Okay. All right. Thank you very much. Look, just very briefly, because not everybody's aware of necessarily what happened to nickel. So do you want to just give it the
so essentially, Indonesia changed the law some years ago that you couldn't export the final product, the raw material from Indonesia, and so you have to process in Indonesia. And essentially, the Chinese funded large nickel processing plants, and so Indonesia is now, flooded the market with very cheap nickel metal, which then the Australian market can't compete against, and so a lot of the nickel mines in Western Australia have shut down, and that's really impacted that commodity.
Yeah, it's basically switched off the industry, hasn't it?
Correct.
Yeah. Okay, Ian, just introduce yourself, how you sit across these industries, and maybe just flag an issue for us to make sure that we've ticked off.
Yeah, Ian Hyman, great to be here. Thanks, Nick. Really enjoy these sessions. I've learned a lot sitting alongside some of the experts that we've done previously. Look, my background really started life as a business valuer back in the late 70s, early 80s, and from there into the plant and equipment space. So my family's been in the P&E valuation game since the 60s. I've got two brothers who are valuers, two cousins who are auctioneers and valuers. So it's sort of in our DNA, to put it mildly. About 30% of our practice is tied up in the valuation of what I call mining services, mining, transport, construction type businesses, often in distress. So our clients predominantly are non-bank lenders and insolvency practitioners welcome Peter Lucas here today, who's been a long-standing supporter. So we're sort of used to working with companies that have got very poor management practices and very, very poor cash flow management. I think we've got about 30 valuers on staff across the country, mostly on the East Coast, and about 20 subcontractors. I think the biggest challenges for each of these sectors is a little bit different. I think on the construction side, government is definitely the biggest challenge, and I think in the last 2 years we've seen a real deterioration in business conditions from both federal and state governments around the country, and a lot of indecision, which has added complexity and delays to construction projects, and I think it's going to get worse before it gets better. And I think at the local level, council approvals, DAs, just to give you an idea, we had a client come over from Perth 2 weeks ago to a lunch that we held. He's building a 150-bed aged care facility in Perth. It's taken 5 years to get the DA on it. 5 years. It's almost incomprehensible. And they're proceeding on, but it's been very challenging. And why would investment put its time and effort and energy and cash into those sorts of scenarios? I think also the indigenous situation is a really big problem around the country, where we've now got competing indigenous interests in the same areas. So you've got to go ahead from one indigenous group and then have another indigenous group that basically says, well, we're the representative body or the group, and we're not happy. And suddenly you've got a court battle involving multiple groups that delays. Federal court delays are 2-3 years. These things just go on, and the costs are horrific. So I think fundamentally it's that's a really big challenge for mining and mining services. And I think the new changing the labour laws for the mining services sector is a huge challenge. With this equal pay for equal work between the mining companies themselves and the actual mining contractors. So there's lots of challenges, and they're very specific to, I think, different sectors.
Okay, yeah. I mean, we hear from economists all the time, and they're usually wrong. I must say, they're certainly usually wrong about interest rates, and they're usually wrong about inflation. I noticed that Warren Hogan from Judo Bank is a contrarian, saying there's going to be 2 more interest rate rises this year, which is interesting. But you are saying what are you seeing? I mean, as a value and auctioneer, certainly as an auctioneer, you're seeing what's really going on. So if we're going to follow the money, I know you've talked about asset values coming off. I mean, tell us a little bit more about what you're seeing in these industries in terms of. I think I overheard you earlier saying that the market 12 months ago is not the market today.
No, look, we really are the canaries in the coal mine. I mean, we're generally speaking, because of where we operate, we are seeing that distress, and it's probably accentuated to a level now that we haven't seen since probably the late 80s. It's still a big gap between what happened back then and now, but this is worse than it was, in my view, post the GFC, which recovered quite quickly. I think we've got a long period in front of us of delay, and I agree with. I support the concept that we're going to have 2 more interest rate rises before rates stabilise and come back down again, because we've got 8 governments around the country who have all got budget deficits for the foreseeable future. We've got share markets at record highs. We've got residential property prices at record highs. You've got a 4 in front of the employment rate. How can we possibly conceive that interest rates are going to come down? So it's absurd. And the only ones that have called that out are people like Warren Hogan. I think Martin Lakos at Macquarie's another one that we look at. But frankly, the non-bank lenders have got a better handle. People like Nick have got a much better handle on where rates are heading than the banks do. And the bank economists are they're a joke in my view. There's been a significant softening in the market over the last 12 months, particularly with older assets. So what we're seeing now is very similar to what we saw post the GFC. In 06, 07, there were massive supply chain issues because of worldwide economic growth. We saw the GFC, suddenly everything came literally ran into a brick wall. Those supply chain issues evaporated almost overnight. And we've seen that happen over the last 12 months pretty much across the sector, all sectors, where supply chains are now almost back to normal. We're seeing discounting now, everything from in the new car market right through to some trucks and trailers, particularly the smaller end of the market. There's a lot of stock on the market. I think if you looked at the Ritchie Brothers sale, which I think, although their site went down yesterday in the middle of the auction and they're having to postpone the auction, but had 2,000 lots in it. That's the biggest sale they've had for some considerable time. If you talk to Mannheim, who we have a close relationship with, their yards are just chock-a-block full of assets at the moment. And a lot of those are distressed. and that's going to continue. And I think it will get worse over the next couple of years.
I mean, worse than the late 80s is quite a statement. And the other thing that's interesting is that the way you're talking, there's downturn, but interest rates, I remember when Paul Keating used to talk about interest rates going up, he used to say the economy's effervescing. But I don't know, it seems to be very mixed signals there. Mark?
Yes.
Okay, so Ian sort of put a little bit of a dampener on things. I'm just talking from an M&A perspective, I guess, in particular, and then maybe you could talk to the actual issues with capital raising. Have you got anything sort of sprinkle a bit of sunshine on us?
I think the only little bit of sunshine is the word on the street, I guess, is that M&A is improving at the moment. It's been pretty down if you look at all the numbers. But in terms of what we're seeing and the market trends in these areas, as we just discussed, or Ian was just discussing, we're seeing a lot of insolvencies are up in construction, like quite a lot. They've really jumped, right? CBA came out the other day saying they're thinking that those will level off in the near term. They're saying inflation is going to keep increasing around infrastructure, and so that then leads to increased inflation. So then that affects interest rates, obviously. We're basically, as I sort of mentioned before about nickel, it's a bit of a mixed bag around different sectors, right? So we're seeing some sectors really expanding and doing really well. So if you're exposed to say copper or gold or whatever you're doing, or coal, you're doing really well. And then there's other commodities. The other thing I'll mention is politically, the Labor government's come out and in support of gas. And so, for example, the energy space in terms of gas is now just moving forward rapidly. So they're seeing supply chain issues and constraints on their supply chain because that market is now really improved for them.
Okay, can I ask, one of my clients, actually we ran a session like this in Sydney a month ago, actually Ian was there as well, and we were talking about business acquisitions.
Yeah.
And one of my clients in WA saw it and he rang me up. He's in the middle of selling his business, and it's a mining services business. I mean, thinking in terms of mining services, civil contracting and construction, what's driving M&A activity there? What are buyers looking for? Are they looking to? Is it organic growth difficult? What is it that they're chasing?
I think the strategic guys are always there, always hunting. I will note, for example, there's a company called Allfabs, which is listing at the moment, which is a mining construction company out in New South Wales, which is also a glimmer of light, because the IPO market's been shut essentially. So essentially, the strategic guys are always there, hunting for good acquisitions, and then it's hard to grow because you need capital. So sometimes people are looking for buyers or investors in their businesses from a balance sheet perspective because of the asset-intensive nature of it. That then leads to M&A activity. So you'll find smaller parties that want to grow, then they're looking for a big brother to help them in the market or expand into other areas. So we see that a lot.
Okay, and I guess, and on the seller side, because we just said that the sellers are looking for partners to help them grow, so they're not looking to sell out altogether.
Well, and I guess the other part of it is, particularly in mining services, we're seeing a lot of handover from folk that are a bit older. So how do they exit the business? So there's a lot of those companies are smaller companies, private companies. And so that is just part of that ecosystem, and those guys are selling, right? Or they've got to manage the transition to new management, and sometimes they can't manage it, right? So there's a lot of activity happening there in the smaller mining services and construction services, just as a general comment.
Okay, Harry. Now you've been a CEO, so you've run some of these businesses, and obviously you're also you're also on the OAM side as well. So you've been selling into these industries as well, and you've got operational experience. So you really sort of sit across quite a bit of it. I mean, what do you see are the challenges that are pressing on mining, construction, infrastructure sectors?
Yeah, I guess if you go back to the history again, for myself, being a contractor, being an OEM, being a distributor and supplier. So I've sort of been across those bases. What I'm seeing today is, we talked about commodity volatility with the nickel, and that's, it's 10 years in the making, but, China and Indonesia, it's a powerhouse nickel project. China uses 5 times more nickel than anywhere else in the world, and so this processing plant in Indonesia, it's not just one plant, I think there's 3 plants. They built them right next to mine sites, right? They put power stations there. It has been a big plan. So they will be supplying nickel for a long time to come, processed nickel. This is the big difference what Mark was talking about.
I wonder if the DAs took 5 years over there.
No, it took 2 years to build, by the way.
Yeah.
I think the Western Australian operation took 9 years to build. Goro and New Caledonia took 15 years to build, right? So interesting, the Chinese were just, they flew their people in, the workers. So it'll be interesting to see what happens down the track. So in terms of volatility, what happens in the downstream effect, especially in the exploration space, and I'm doing a lot of work in the exploration space, all the drill rig contracts have stopped. The guys have to look for other commodities to chase or other mining companies to go and work for. People I'm working with in Kalgoorlie, they got drill rigs parked up. I counted 16 parked up the other day when I was in Kalgoorlie, and that's pretty sad for a small.
So we're
town.
back to that.
So they have to go now looking, and I work with Port Longyear as a contractor. The focus there was gold, copper, and in those metals, this recent lithium and nickel for the EV market is people are chasing this big space.
It's a massive as gold.
It has been, yeah. So there'll be a correction for sure.
I'll tell you what, I'm really interested in a couple of things. Drilling, because again, we're sort of looking at the subcontractor level, is what, right? So,
yeah.
So I remember, when we first started Hermes, the mining sector was going like that, and I think Ian would agree that the drill rigs were going up, and drills are a bit of a canary in the coal mine as well, right? Because you talk about there's only so many things you can do with a drilling rig, obviously. You know what I mean? So you talk about looking for work. One of the traps for drilling contractors is doing work for free, effectively, for equity.
Equity.
Yeah. Is there more of that happening now? Or?
I couldn't comment on that one.
Yeah.
There has been.
Yeah.
And there's been a number of companies do very, very well out of it.
Yeah.
And there's companies that have a portion of their funding to capital.
Right.
Maybe 5% of their spend is on this. I guess they don't drill for nothing.
Yeah.
They drill for cost.
Right.
Okay.
So just explain that.
Well, I'm drilling.
They'll charge costs.
Yeah, there's no margin in it.
Yeah. So again, you've been on the contract negotiation side of things as well. So, one of the problems being a subcontractor is that balance of power. What's the balance of power between subby and contractor like at the moment? Is it?
Depends on who you're working for.
Right.
If you're working for a tier 1 company like BHP or Rio Tinto, you don't have any power. You will have to improve your drill rig that can drill deeper, and they're not going to pay for any extra. They want hands-free operations, autonomous. You're not going to get paid for. So there's some compliance there that the drilling subcontractor has to do. And then there's the tier 2s and tier 3 drilling contractors and those miners as well. It's probably a less compliance there. One of the other things I'm seeing is that the resource depletion, mining companies have to go deeper now to look for resources. So there's a consequence for drilling contractors that have drill rigs that can go beyond 2,000 metres. So that's another play as well. So there's quite a few contractors are looking for rigs that can drill beyond 2,000 metres.
Well, that's a capital raising opportunity for an equipment
100%.
finance broker who's
Absolutely.
looking for something to sort of get their teeth into.
And I guess workforce issues. I've got my brother's in the building game. He can't find today. I spoke to him this morning. He can't find a forklift driver. He can't find a truck driver. He can't find people to work in his factory in Wakehold today doing stuff.
Well,
So it's quite strange, right?
that's a problem. I've stayed in about 3 or 4 hotels over the past week, and everyone seems to be brand new, and they're not quite sure what they're doing, and they seem to be being. And then they'll call in the expert who's probably only been there for a couple of weeks. So I don't think it's just in this. I don't think it's just in mining services and construction, but obviously, it's one thing to get someone to do some work that you can maybe get trained up in a week. To operate a drill rig or operate heavy machinery, obviously there's certifications and all sorts of things. So that's a problem. Okay, well, Ian, coming back to yourself, I mean, you're a valuer, so why don't you, I guess, brokers have a sort of a love-hate relationship with valuers sometimes, don't they?
So do funders sometimes, Nick.
So do funders. Oh, okay. Well, hopefully you're more interested in appeasing.
I was going to say we've got a gold plant at the moment that we're trying to fund, and I can't fund it because no one values the valuation. If you know what I mean, so we've got a val. Funders basically saying it doesn't matter.
Well. I mean, if we can just sort of go off script there for a little. We get given, for example, quarries is a classic example. Someone will give you a quarry valuation, and it's really a business valuation. I mean, it's not really a hard asset valuation. So a lot of lenders, such as myself, we're interested in hard assets. We're not enterprise value lenders. We're not lending on EBITDA multiples, and that's effectively what some of those mines are, which is very interesting. And Anne and I are working on one at the moment. So what are the big factors that you're considering when you're valuing assets in these sectors at the moment? What are the things that stand out? Is anything changing, or in terms of your approach to valuations? I know that if you give me a valuation, it's what it's worth today. You're not saying this is what it's worth in 6 months. This is what it's worth today, and then the market can go up and the market can go down. But what are the factors that you're looking for?
Well, we do value for today, and we're obviously looking for sales evidence that is as recent as we can possibly find. We were having a conversation before we started today about the challenges of using in the current environment where we've been through this massive roller coaster of supply chain issues, people movement, etc., how costs have increased, and suddenly we've got a significant return. The norm is probably not quite the right word, but certainly we've come a long way back to where we were before COVID. So, I think the critical thing for us is having data which is current, and trying to talk to our P&E valuers in particular about comparables and looking at information that's even 6 months old is often misguided. It's actually misleading, and drawing inferences on that where the market is right now can be well and truly overstated and incorrect, and lead to some embarrassing moments down the track when it comes time to sell those assets, and looking at how do we arrive at those numbers in the first place. But last year when the instant asset tax write-off sort of came to an end, it got cut to $20,000. We saw a massive drop in asset price. We were very busy in that quarter before the end of June with a number of asset financiers, and then it fell right away in July or September. I think our volumes fell by more than half. And prices fell by about 30% across a lot of sectors, particularly with older assets. And when I say older assets are more than sort of 10 years old, but still a significant impact on assets that were less than 10 years old. And then we flatlined then until the end of January, and then we saw another big drop sort of in February, March, April. And now we've sort of stabilised again at a lower level. So if you took a loan or you provided asset finance from basically the beginning of COVID, or say 3 months after COVID commenced, right through to the first half of 2023, and you have a client who's now in distress and those assets come onto the market, you're going to take a pretty significant hit when it comes time to dispose of those assets. And it's very hard sometimes, particularly with brokers who, a lot of brokers are one-man bands. The deal is the deal. They've got 1 or 2 deals running at any given time, and the valuers can also make or break those deals very quickly. It's really important from our point of view that we try to communicate past all the noise about where the market is, and actually, discuss how we arrive at our numbers, and to invite, sometimes clients have got a view, often their assets are worth more than what we put on them. We ask them, give us the data. We're on your side. We want the deal to proceed. Tell us where, if you think we're being conservative or we're misleading, give us the sales data that we've.
Where do you pull the data from? Auction results locally, but how how relevant is data from overseas?
Well, look, let me give, it's important. And the more complex the equipment, if there is a global market, you're not going to move a 5-ton excavator across to the US, but you might bring a 100-ton excavator across to the US. So it really does depend. And the markets change internationally all the time, but we look extensively internationally at asset prices for larger and more complex assets, particularly things like processing and plants for minerals and so on. But obviously our first place is here, because if we can find accurate data here or recent data, that's going to give us a good lead into what we might expect in that immediate time frame. But seriously, the challenge at the moment is that we've seen this up and down over the last 4 or 5 years, and it's one thing to value now. It's very hard to foresee where things will be moving forward. I think we've largely stabilised now in the used equipment space. We may see another 5, maybe 10% over the next 12 months of further settling, but I think we are largely where we are.
But it does make capital raising very difficult. Sorry, I have to just do another little break. Zach, is that so? Ian, you were just saying about valuations coming off now, Mark. I guess from a business valuation point of view, I'm interested in, but also we're talking about from a capital raising perspective. I mean, how does this impact on equity when you're doing an equity raise if hard assets are coming off?
Oh, well, it really affects the value of the business, right? So I guess what we're doing, if we're going out for finance, what we're trying to do is present the company in the best light, and that includes the balance sheet, right? So there's a number of issues there just generally. So quite often the company is minimising tax, so the balance sheet doesn't reflect the true value maybe. So there's an issue there. So we talk about management accounting and getting that right. Quite often these private companies don't have that right, and that's a big issue. Next is the actual value of the assets. So then we've got to go and get a valuer to do the proper valuation of the assets, and can be a large discrepancy between the balance sheet and the the valuation, obviously. And then what we're trying to do is put a forecast together around the business. And so there's two parts of it. One is the assets of the business, and then the cash flows those assets can generate, right? So all of those things impact how the funder is going to look at it. And then we have a range of funders, that we can talk to. But quite often it's putting a strategy together with the business and the funder to get to yes, if you like, so that we're all aligned and the deal's going to work.
And with business sales, are people taking an equity approach and buying the business, or are they buying the assets?
Oh, it's a bit of both, right?
Yeah.
So we had a chat yesterday in my office with a party, and he was talking to a broker, and he basically said, who sells businesses, and he basically says, no, in the last 6 months, none of the businesses have reached the value that the vendor wanted, right? So they're all taking a haircut, basically. But that's a combination of the assets in the business as well as the valuations. So valuations have come off, and I guess that's also reflective of the real assets of the business.
Can I ask? Okay, so now you're raising all sorts of weird and wonderful stuff, equity, and I appreciate that you're talking to offshore capital providers as well. But how are you finding the local market, like with the major banks, for example?
So essentially, we're operating mainly in the non-bank space. So essentially, our general view is the banks aren't lending, they're not providing overdrafts, and if the bank's already banking a company, they don't need to move. So quite often we'll take the bank out and refinance the whole deal. So we're generally working with specialist folk and have other access to capital that sometimes companies can't access. And then what we're seeing, a lot of times is there's other wrinkles that you've got to overcome. So it could be ATO debt, could be the balance sheet and the value of the assets, so we've got to solve those problems then to get through to the next layer of funding. So eventually we might be able to bank fund it, but we might need to bridge.
And what about something that's come up in my travels, particularly in WA recently, is price sensitivity. So what we're finding is on the East Coast, borrowers seem to be less price sensitive. In WA, business owners seem to be that they'd rather shut up shop than borrow at a higher rate. Now, one of the anecdotes I heard was that one of the banks had approved a deal, but it was maybe 2% dearer than what Westpac would provide or whoever the major trading bank was. And the borrower, it took 3 months to get the deal through a major bank, whereas this other non-major bank had approved it 3 months prior. And I'm thinking, well, surely they would have made up the money. And the money they would have made with that capital would have made up any price difference. I mean, are you seeing price sensitivity, or it's just?
I think it gets back to the owner. So I think there's some stubbornness there, if you like. So the way I'd approach that is you can do that, give them options basically, but quite often taking a higher price and being more flexible is a better option than a longer deal. It taking longer to get the money, and then you can always get the money later, if you know what I mean. So we're quite often doing multiple tranches of money to move the business forward over some period of time. So we're basically putting a funding strategy together for the business, and it's not a silver bullet because there is no silver bullet, right? And then quite often the founder or the business, is just backing one horse in the race, and the horse falls over,
Right.
And then they get into trouble, right? So they're trying to get that lower rate,
Big
let's
project.
say, and then it all falls over. Like I got an email this week saying banks withdrawing funding, need $10 million, please send me your proposal, right? But I spoke to them last October, and they should have got the money back then, and then I could have refinanced it out later and it would have been fine. But
Are you seeing much of that? Banks pulling out of deals?
we've seen one recently where they got a term sheet and then credit just pulled it, or but I don't see it very often, but I don't like it when I see it.
Are you hearing any of that, Ian?
Well, mate, we caught up with one of the major banks senior execs yesterday, and he was saying that they've flatlined this year on their lending. They'll be lucky to hit last year's number. So I think there's certainly credit policies have tightened up. Can I just go back to the business valuation side just momentarily? Because our challenge as business value is, as Mark referred to, is around normalising the P&L on the balance sheet. And most of the P&Ls and balance sheets we see are basically almost written in handwritten in ink, and do not reflect the business in any way, shape or form. So in a business valuation process, 80% of our time is actually working out what is the bottom line and what is the actual balance sheet of the company. And that can be for a whole range of reasons, from running it like a personal bank account to uncommercial transactions between related companies, and a whole, key individuals in the business having outside interests, which has taken them away from the company, but they're being paid at commercial salaries. All those things impact on the profitability of the business and the bottom line. And obviously over the last 12 months, or 15 months, as rates have increased, that affects yield. So people's expectations about where a business might have sold for 2 or 3 years ago and what they're going to get today are quite different, because yields are so much higher in other avenues, and you can get a higher rate of return. You need to get a higher rate of return on a business purchase because it's a much riskier investment. So getting the brokers to talk to their clients about that is quite challenging, and getting to understand and make their clients understand that what they thought their business is worth often is not a true reflection of the market.
Harry, anything to sort of pick up on?
I'll probably give them a light on in terms of positivity.
Yeah, please.
Automation, robotics. I think some of the technology trends and innovations that I'm seeing today, especially around AI and real-time data collection. Now, as in the drilling space, people want drilling data straight away, so they want it actually coming out of the hole, so to speak. What I see on a lot of equipment that's being manufactured today, they're including the AI and also real-time data collection, even underground operations in Western Australia and also in Victoria, we're collecting data, and you could be sitting here on your phone, you could be seeing how the drill's working and understanding the geology. So some of the data that's collected can go to different departments, whether it's mine planning, geology, engineering, maintenance, and operations. So there's so much data that's collecting. Also, from an AI perspective, the more data you collect, the better you can drill. So the machines are actually machine learning, and they're actually drilling better than the drill operator. They're getting better core recovery. So that's some of the things that's really interesting. Digital twins, I'm not sure if you guys are familiar with digital twins, but there seems to be quite a push on digital twins. It's having a simulation in a virtual world of the same asset. So you're actually testing it before you put it into place or build it.
So just explain that a bit.
Digital twins,
Yeah.
It basically is a simulation of that asset,
Right.
created in a virtual world.
Yep.
All right.
So e.g.
Could be a plant.
Yep.
Could be a piece of equipment.
Right.
Could be in the oil and gas.
Yeah.
They tend to do quite a bit of it in the offshore stuff.
Yeah. Right.
Right. So you create this virtual replica.
Yeah.
It's like a simulation.
Yeah.
In the virtual world, and you can actually test it before actually implementing it.
We could be
Right.
somebody else. We won't
So
go into
that's-
a simulation theory, but maybe we're a simulation. But never mind that. So it's a little bit like when you look at a room, your architectural stuff, but it's just obviously to the nth degree. So I'm wondering, you're talking about AI now. 18 months ago, AI was just something you occasionally heard about, and all of a sudden everyone's using ChatGPT. To what extent is capital equipment? Like if you go back to the early 90s, you had your 286, your 386, you know what I'm talking about, the 486 computers. And then, they stopped calling them, whatever the numbers were. To what extent is heavy equipment now a piece of technology? And then is there obsolescence risk?
Oh, absolutely. I think with a lot of the equipment on a drill rig, for example, one of the rigs I'm working with at the moment, there's something like 30 sensors on the rig. That's data.
Yeah.
Whether it's water flow, pressure, rotation, there's a number of data points that's collected. And not everyone wants to see that data, but certain people do, right? And if you collect it in real time, for a maintenance guy, it's predictive failure. When is that rotation head going to fail before it fails? For a geologist, they probably want some data around the kind of geology they're drilling in to make a different plan. So if you can do this in real time, it saves a lot of headaches down the track.
Now, if you're an equipment finance broker, what do you need to know about this equipment? You're not the lender, obviously, but you maybe need to sell a lender on funding this particular equipment. I mean, what are some of the things that you should really know to be able to make the case for lending against this stuff?
I think some of the bigger OAMs are starting to incorporate some of this new technology, whether it's IoT, which is the real-time data collection, or AI in their drilling operations, or even safety functions, autonomous. So I can remember sitting in front of the Rio Tinto optimization manager a few years ago, and he talked about a green rig. By 2030, we want to see green rigs out there. So no diesel-powered rigs. They have to be electric. And this is coming in time. But in some operations in the middle of the Pilbara, having a battery-powered rig is not necessarily going to work in the moment until you have 24 battery packs, right?
Yeah.
So there will be at some point in time a change, whether it's hydrogen or another kind of commodity or product that's used.
So the same factors that seem to be driving everything, I guess, environmental factors and sort of safety is another big driver as well.
100%.
Yeah,
especially around the ESG and the reduction of emissions in the atmosphere. I know the oil and gas space, they're not flaring off gas into the atmosphere. I think that's a fairly hot topic at the moment. Being able to capture the methane before it actually gets flared and reuse it or put it back in the line or recycle it.
And is this gear is in the hands of subbies? It's in the hands of wet and dry hire. I mean, who's buying this stuff?
Drilling contractors.
Yeah.
I haven't seen too much in the hire space.
No, okay. So it's the actual contractors.
Correct.
Yes.
Yeah.
Okay. Which are usually small businesses, effectively.
Yeah, and you tend to see it's in the tier one drilling contractors that have the big contracts with the bigger mining houses have been, I guess, asked to have real-time data collection, have emission control or compliance.
So this is part of their. This is part of winning jobs. I mean, it's spec'd into contracts.
Absolutely.
But it's all about efficiency, right? So, it's like manufacturing company buying robotic, manufacturing equipment. It's similar, right? So really the play, I guess, is the operation is going to be more efficient. The issue from a funding point of view is this is really capital intensive, and so you've got to make sure that you're generating the working capital and getting those efficiencies. So the idea presumably is we're dropping labour from the corporation, right? And so the issue there is, have you got the right people to run?
Okay. So one of the ways that a finance broker sells a finance deal for a particular piece of equipment is that because they have to sell serviceability, and one way they sell serviceability is to say that there's going to be these will be the monthly repayments, but here's the extra revenue that we can generate, but also here are the cost savings. So can you speak to that a little bit?
So I think it's about basically putting a business case together for buying the plant and equipment, and then I think it's around getting the right funding. So quite often we're seeing, particularly with equipment funding, and when I talk about the banks, maybe they've got a short equipment financing term, a larger balloon, and all those sorts of issues. So I think from a funding point of view, the company's got to be really careful about having flexibility around that funding and finding the right source of capital for that equipment. And then I'll just throw the ESG lens on that as well. So we've seen mining equipment previously that is roaming around the market looking for funding, and funders won't fund it because it's coal so there'll be another lens there from the funders. So you need to think about that as well.
Are you still seeing the reluctance? Because someone, I think it might have been you, that was saying before that coal's going really well, but are there still the ESG? Are funders still knocking it back? Is there still a black bag?
Well, I think it depends on. So there's different pools of capital, but more and more those pools of capital are moving towards, the ESG metrics, if you like. And so boards, and like the large banks are making calls around whether they're going to support thermal coal or not thermal coal, or low sulfur thermal coal, etc. Right. So if you've got and then quite often, and we just did a deal recently, less than 5% was in thermal coal, and so the funders would fund it, even though there might be a small amount.
Right.
Yeah, so it sort of gets back to what the mining contractor or services, what's their portfolio look like in terms of customer base. If it was all coal, maybe they wouldn't get that funding from that funder, right?
All right, Ian, just sort of picking up from what Harry was saying, it sounds to me like there is a bit of a technology factor that comes into play. So again, from a funding point of view, in the old days, when we were funding computers, for example, you want them fully written off over 3 years. Like you wouldn't be funding a computer over 5 years with a 50% residual value. How are these AI, for example, in a piece of kit? How's it affecting evaluations?
Well, the major operators such as BHP and Rio, they're 10 to 20 years ahead of anybody else. And I guess the challenge for them is going to be when the equipment that they've currently purchased, which is automated, comes to end of useful life for them, that normally would go into a secondary marketplace where a smaller mine might pick that up. To actually be able to organise and coordinate that type of equipment, you've got to have a fairly specialised workforce, and they're not generally around at the moment. So I think there's going to be a real challenge around moving that equipment back through the market. There's been some talk about actually converting the equipment back to non-autonomous after it's finished its autonomous life, so it can go into that secondary and that second tier and third tier marketplaces. But I think at the moment, a lot of that gear would be almost, let's say, unsaleable, but in comparison to the equivalent of, say, a conventional, say, 740 dump truck, which is not automated, which would fit into the market right now very easily, as opposed to an automated unit which may have a very limited marketplace.
So that's interesting. So you're going to de-spec stuff so that
I think there'll be a changeover period until this equipment becomes more accepted and more affordable for smaller miners. The second tiers will go first, and then there'll be the small mining companies that will struggle with that technology for quite some time, in my view. We might have a different view on that, Harry. But
No. There is a drive to reduce the workforce because they can't find the people to operate rigs now, and some of the workforce actually people that have no experience, but they know how to press a button and understand technology.
Yeah.
Right. So the old drillers are, unfortunately, are going to be working on the manual type rigs unless they adopt the change.
Yes.
There's definitely a big push in the autonomy. At the moment, there is a full autonomous RC drill rig being manufactured and tested today, and it's been built in Ireland, a company called Tribe, and that's going to Western Australia. They got 3 built, but it'll be interesting to see how that plays out in the workforce. The company I'm doing some work with at the moment, they've got a fully autonomous underground rig, all right, but there'll still be need to have someone on site, all right. So I guess the wording around fully autonomous needs to be clarified as well.
Okay. Now, Ian, what are you finding finance brokers are saying to you? There's any particular gear that they're struggling to finance?
Look, I think it's sector by sector. It's certainly construction much more challenging. I think if you go back to 2020, 21, there were a number of funders out there that would do formwork, scaffolding. A lot of that credit sort of disappeared from the marketplace, and we're now starting to see a fair amount of fraud out there. We haven't seen fraud for quite a long time. So
talk to us about that, because brokers want to obviously avoid that, because they often get tarnished, even though there's 10 sets of eyes at the bank have looked at it, and they don't want to take any responsibility. They try and blame the broker. So how can they avoid that? And what are you seeing?
Look, I don't think the brokers can really do much about that. It's really outside of their control. But I'll give you an example. We've got a mid-tier brewery in Victoria at the moment. It's been funded by a second-tier bank. There are 8 other financiers involved. And yesterday we found out there was another bank involved that has a range of PIMSs, registered over equipment within the company. But the assets have moved from one company to another. They've been refinanced to the new company. And because they're non-mobile assets, they're not registered by VIN or PIN, there's no real way of tracking those across the PPSA, the PPSR, the Personal Property Security Register. So we're now analysing those assets. We've got in some cases 4 claims, clear fraud, 4 claims.
So not quadruple financed.
Correct. Yeah. Quadruple financed.
Yeah.
And in addition to that, the director has also angle grinded off a number of plates off equipment, which means that where we've got multiple assets of the same type, even if we did know who they belong to, we can't allocate them because we've got no way of identifying it. Even the model number's been removed, so we don't know. We might know the brand, but we don't know the model number. We don't know the serial number. We don't know the date of manufacture. So marrying those back to the original paperwork has been an absolute nightmare.
So it's funny. I guess we get more and more sophisticated in fraud detection and but the same old rackets keep getting pulled. So how are you supposed to sort that out for the lenders?
So our job is to search the PPSR register in the first instance, and we obviously qualify our report to state, look, this is our best efforts, and you need to make sure you go through your own discovery process. Some people do that better than others, and this particular instance that I've given you is going to be a very substantial write-off by the second-tier bank, unfortunately. And somehow in their system, their controls have really let them down. But I think overall, we're now seeing this on a number of jobs. This is not isolated, and I think people have learned how to game the personal property security registers.
Yeah, well, I mean, look, an old friend of ours, a mutual friend in Melbourne, had a saying that people are as honest as they are profitable. And we are, I mean, I know that you and I had a recent experience where, well, it didn't affect you so much, but it affected me, where someone had financed a piece of heavy equipment. Someone offered us security over a piece of heavy equipment, and we did everything right under the PPSR. But it turned out that they bought it off someone who actually owed the bank on it. But the way the PPSR works, we didn't search that other company because all we did is search our client, and it gets very, very messy. Look, I want
to say one thing there. Under the PPSR, you've got a number of asset classes that are designated under the PPSR, specifically charged by a serial number, bin number, and they tend to be mobile assets that move at a rate of more than 30 kilometres an hour. In addition to that, you've got aircraft engines and marine craft. Every other asset that sits outside of that, and that's, to be honest, the bulk of assets, sit outside of that, you can only search the company that you're looking at financing. It's impossible to go across the entire register.
Well, yeah,
and check for those.
Yeah.
And check for those. Whereas
without going to source documents.
Correct.
All right, listen. Okay, look, we're kind of running. The clock's running down, and one of the areas I really wanted to get to, because it concerns me, is just the nature of contracts themselves. I mean, one of the things that Hermes specialises in is financing progress claims, right? And one of the unique features, whether it's mine, unless you're talking wet and dry hire, which obviously is prevalent in everything, but you've either got wet and dry hire, or you've got contracts that are either subject to quantities, or assessments, so providing funding against those does present some pretty unique challenges. I mean, Harry, I guess you've probably been more involved in contract negotiation than sort of anyone else on the panel. I mean, what are some of the considerations that you give in terms of just making sure you get paid when it comes to these contracts?
Interesting question. I think the payment schedule, and having a fairly rigid discussion with the finance team right at the beginning on both sides of the owner and the contractor, or the customer and the contractor, and clear lines of guidelines of what's acceptable and what's not. Sometimes those conversations don't happen, and I know that I've taken finance people to meet finance people, so they know they can pick up a phone and actually talk to that person. And the biggest thing you miss out on is information. You don't get a phone call. You don't know what's going on. So if you had a phone call from a finance CEO or CFO, hey, I'm a week late, or we've got some issues, you can actually plan. It's about planning and understanding what's going on. Basic communications is probably one of the keys here. And I think getting it right at the beginning with the team on both sides of the fence is really, really important.
Can I make some comments?
Yeah,
so we've just been helping a client in the supporting construction, I guess, instead of a manufacturer. But a couple of things just to pick up on there. One was they're bidding work packages, I guess, and they're a subcontractor to a contractor. So depending on the power between the two parties, sometimes they have to sign they're a subby to the contractor. Sometimes they have to sign the contractor's contract.
Right.
And so there's terms there that are not favourable to the subcontractor. So that's one point. Second point is if they can get their own terms signed, that's better. But actually, when we went through their contracts, they were missing just basic terms around, holding of the gear until they get paid, and who owns it. Like really some stuff that they could tidy up a bit better. And then the other thing is the payment. There's a difference between bidding a work package, and that's normally broken down into work streams and stages and blah blah blah. Then there's a separate thing about invoicing. So they weren't communicating to the main contractor about how they were going to invoice. And so if you're the accounts payable person at the contractor, they were getting different invoicing from the work packages, if you know what I mean. And so that's a communication issue, but it actually wasn't dealt with contractually. Right. So then it becomes a contractual dispute. So then the main contractor says to the subcontractor, I'm not going to pay that because you're supposed to deliver this work package. They were delivering the work package, but differently from what was quoted. So that all of those things become issues contractually.
Well, it's interesting. I was reading, I don't know why, but I was reading up on Snowy 2.0 or whatever it is. And I tell you what, there's some differences there, isn't it?
Is it?
Like we're talking about billions of dollars.
Is it still going?
It's quite frightening.
I thought the tunnelling machine had started.
It's having a rest.
It's having a rest, is it?
Overworked.
Nick, sorry to add. I think variations is one that has a lot of issues in most contracts as well.
Yeah.
You have a scope, but things happen outside the scope. And getting approvals to actually get that variation, first of all, completed, agree to, we're going to do this variation. And sometimes you just go and do it. Hopefully you'll get paid. All right? And I know that I've been in that case. We'll drill an extra few metres for you.
Yeah.
And we didn't get paid.
Well,
not in your contract, So
no, because usually it's on site. The guys on site, they all know each other. They have smoko together and whatever it might be. And she'll be right, mate. And it's not documented. And we see it time again. Like we'll fund a progress claim. We'll fund a variation when it's all done and agreed to in writing. Because I've seen too many times the project manager say, "Listen, mate, if you can you just do that for us, and we'll sort it out. Don't worry, you'll be sweet." I'm sure this is what you're talking
Absolutely.
about. And of course, it doesn't always play out that way. Listen, I've got one final question for all of you, but we are running out of time. So I just thought if anyone would like to throw a question, this is your chance.
Nick, I've got a question. I'm not sure if we've really covered it in detail, but particularly in plant equipment hire, the termination for convenience clauses, are they still prevalent? Are they being exercised? And what have views from funders sort of changed when they're in the contracts?
When I look at a contract, I don't read every single line in a contract. We to some extent we rely on checking with the contractor periodically every time we fund a claim to make sure that they're happy with it. But of course, then, as you say, what if our client becomes insolvent? Then these are the sort of things that come to play, and terminations for convenience and all sorts of other nasties come about. We've got one interesting situation at the moment where there's our client's been doing work for different entities in different states and trying to some of the projects were complete, some of the projects weren't complete, and then having offsetting claims from different entities. So they're still. We still see all sorts of stuff. So, any of the other guys want
to? I think so. Part of the issue is, well, contractually you can deal with those things if you write the right contracts. So even in our contracts, if someone wants to terminate for convenience, they're going to pay us, right?
Yeah.
So we've got a poison pill in there that there's a fee, right? So then. So there's ways of contractually dealing with it. The issue is, does the counterparty have money, right? So depending on what happens, to your point, if they go insolvent, they've got no money to pay anyway, so it doesn't matter, right?
Yeah. So
I think you can deal with it legally, but part of it is around, we've sought advice from lawyers, and you can have really onerous contract terms, but then you're never going to sell anything, right? And so the issue is, there's a tightrope that you walk between normal best practice around contracts and actually being able to sell your services, right? Or being able to, or you're being forced to sign someone else's contract to be able to provide those services. In the example that I gave earlier, so it's a real difficulty for private companies sometimes around walking that tightrope. And then generally, what tends to happen over time is people tighten their contracts as they get hurt by these clauses, and then they get advice, right? But sometimes the large contractors have got pretty onerous contracts that you have to sign, and you can't do anything about it if you want to work.
Yeah, I think it depends on well, I mean, it's hard for the small guys to negotiate those terms away because
It's impossible.
yeah, depending on how specialised, I guess, what they're doing is, but yeah, generally speaking, their terms take it, don't they?
Well, so one of the big issues I've found, and this is from my past life, we were dealing with a very large mining company, and they had clauses in there that if they had lost production, we're liable, right? And we're just providing a service. And so we would try and limit those clauses or get rid of them, or all sorts of remedies, if you like. But some of the clauses that you get presented with originally can be pretty confronting, especially if you're a smaller private business.
Harry?
And sometimes the bigger companies send you this generic contract that you have to actually go through it with a fine-tooth comb and remove things that aren't applicable. And sometimes you can fall a trap by not going through it and checking that there's things or departures. We can't comply to that. We can't do this one. We can't do that one. And not only getting checked internally, but someone else having a look at it. When there's an opportunity, it can cost you. If it's likely to happen, what's the consequences, right? And if you don't do the homework up front, it can cost you down the track.
So just to sort of a little bit more specifically to what Anthony's asking, I mean, as a financier, we're interested in this claim, and is this claim going to get paid? So, the overall contract, obviously we want our client to be successful in completing that contract and not to having the rug pulled from under them for whatever reason whatsoever. But as an asset-based lender, I guess if we read every fine detail in every contract, we probably would never lend a dollar. So we rely on our subcontractor's contractor to tell us that this claim's okay, this claim's going to get paid. That doesn't always happen, obviously. And then you have the problem that if they do terminate, there's liquidated damages and back charges and all that sort of stuff. We live life claim by claim, one claim at a time. Any other questions? All right. Well, look, guys, if we could just finish up with briefly, maybe just where you think the opportunities are for people that are providing advice to subcontractors. So what do you think the opportunities are?
Look, I think finance brokers that work in the sectors that we're talking about, from their perspective, they've got a unique window into working in that space in finance, and that's mining's a very, very specific area that requires specific expertise, and a lot of contractors in particular don't have experience in dealing with financiers, and therefore the broker really can bring some significant value, in my view, from what I've seen over 40 years, to their customer, to their client, in assisting them to get the right deal for them. So I think a bit like today, where we've all talked about what our skills are, what our background is. Make sure your customer, your client, knows the full extent of your capabilities. And I think a lot of the time they just see you as a conduit. You're going to put the proposal form in or handle the finance, but you're a lot more than the brokers. Are a lot more than that. They can provide a lot more value. And unfortunately, more often than not, directors do not see them as that value add that they can be. And I think it's a really important miss.
Yeah, I'd agree with that. And then the other thing is if for example, if the broker sees issues in the company that need to be solved to get the financing, then get the right people around the company to solve them. So, a lot of the stuff we find is around cash flow, balance sheet, just presenting the accounts, tying a pink bow around it, so when you're going to talk to the funder, it's all sorted. And then just making sure you've got the right partners and people in your ecosystem that can support. And then if you get a good client, you're going to keep funding them, right? So they're going to buy more equipment, they're going to be selling stuff. It's an ongoing opportunity for the financing.
Sure.
I think there's the word coaching comes in. I think we talked about that. Some of the businesses I'm working with, and I've come up with 5 areas I tend to focus on. systems, process, data, people, structure. And if you look at that, and it doesn't matter whether it's Rio Tinto or a backyard company, you look at those 5 things and you can find gaps where they can improve with systems, processes, data. Do they have the right data today to make a decision? The people, have they got the right people? Do you have the right structure for today and tomorrow? So there's as brokers and managers in the business, you should be looking at that as well from a helicopter view down. What systems they got in place? What people they got in place? Do they have the right structure? Do they have the right data to give you the data to actually make a decision today?
Okay, well, look, I would like to finish up by saying I would like to pick up Mark's point. Certainly, one of the things that we like to say at Hermes is you're not just talking. We don't just bring money to the table, but we bring a network to the table. And I think that's very important for brokers as well. It's like you can't know everything. I can't solve those problems that you solve. All I'm doing is providing the money. I certainly wouldn't attempt to solve them because I certainly don't have, I don't want someone suing me for a bum bit of advice either. So I think it's important to have the networks and to have the connections. I can't remember what you called it.
Ecosystem.
Ecosystem. That's what it was. To have your ecosystem, to have your posse, whatever it might be, your own cadre of trusted advisors, so that the client knows that you've got the right people to talk to. It's a little bit like the other day, a client of mine in WA is selling their business. I was able to introduce them to one of the chaps that was on our table the other day, Andrew Casson, to help him with some sell side advice. And I think that's really important for a finance broker or anyone really, just to have that solid team around. So I would like to say thank you to each of you for joining us, for participating in the panel today. And I guess Ian Hyman, we'll put links to Ian and Mark and Harry in all the socials, and you guys obviously, bit of circulating. You guys will be here for a little while, and thank you very much to everybody for coming along. Cheers.
Thank you.